Our mission at SD Bullion is clear. The lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc with the SD Weekly Metals and Markets Wrap. Joining us today once again is our good friend from the other side of the pond, James TURK, founder of Gold Money and the co-author of The Money Bubble, What to Do Before It Pops. James, it's great to have you back on the show.
Yeah, hi, John. It's great to speak with you.
Well, it's perfect timing to have you back on the show, James. We finally have some action to the upside in the gold and silver markets here over the last week or two. And it seems, kind of looking back a little bit, that the excitement began about, at least in silver anyways, about a week ago with the London fix coming in about 85 cents below the prevailing futures trading at the time. Here we are this first week of February. Gold and silver been trading strongly. Somewhat apprehensive I am ahead of tomorrow's payroll report. We'll see what happens, but gold has cleared its 200-day moving average. Is trading here. We're recording this Thursday morning. It's actually above 1150, and silver is trying to make an attempt on the $15 level. So let's start with your take on the trading action here in early February, James.
Yeah, let's start with that fix, where it fixed at $13.58, whereas the paper market never went below 1404. I mean, that was really quite a shocker, and by coincidence, I was actually following that very, very closely. I couldn't believe it when I saw it on my computer screen what was going on. It is an outlier, but it is a wake-up call. I think it's showing that there are first of all, it's showing that there are two different markets out there, the paper market and the physical market. But in this case, it's also showing something important. What a lot of people don't realize is they look at COMEX options and they think when the COMEX options go off the board, that's it for the month. But the reality is that the over-the-counter markets that trade here in London continue to expire after the COMEX. And on that particular Thursday, there were over-the-counter silver options expiring based on the fixed price. Now, it doesn't necessarily trade through the LBMA because when you're dealing in options, it's not necessarily a physical metal trade, so it doesn't necessarily deal through the LBMA clearing system of metal, but it is used as a reference price. So what it basically meant is that everybody who had an over-the-counter market silver option expiring on that day, priced at $13.60 or above, got wiped out in 1 minute. The minute before the fix, silver was trading at 14.20. At the fix, it went down to 13.58. All of the silver options above, over-the-counter silver options above 13.58, basically 13.60 and above, expired worthless. 1 minute later, the silver was back at 14.20 again. So it was an obvious manipulation. And at the time, I said to some friends, there are going to be lawsuits over this one unless the bank who ripped off the customer quietly settles out of the public eye. We now know that who the person got ripped off was the big Polish miner, one of the biggest silver miners in the world. Apparently, they wanted to get some clarity from the LBMA. They didn't say they were the trade, but it seems quite clear that they had some position on that fix where they were selling physical metal into the fix.
Now, James, are you surprised that the CME didn't void the trade?
Yeah, one would think that they would void the trade, but what the CME, if they voided the trade, they would say that this new system that they put into place isn't working anymore, and they don't want to admit to that. But it's quite clear that this system isn't working. Under the old system, the banks that were participating in the fix had the responsibility for maintaining an orderly market during the fix. And consequently, they would buy and sell for their own account in order to keep the physical market pretty much in line with the paper market. That changed when the CME and Thomson Reuters took over the fix. The responsibility now lies with the CME and with Thomson Reuters. So the banks, are free to game the system as much as they want because it's no longer their responsibility to maintain an orderly market. So what the LBMA and everybody did is they've taken a huge step backwards in terms of creating a system that is inherently extremely volatile because there is no responsibility by anybody to maintain an orderly market. The CME and the Thomson Reuters don't trade for their own account like the banks used to do.
I want to get your thoughts here, James. I mean, since that time, 7 days ago, both gold and silver have rallied strongly. Do you think there's any sort of correlation with that obviously manipulative fix, or is it simply coincidence in everything we've been seeing with currencies and NERP and the dollar index over the past 7 days?
I think it's just another piece of evidence that somebody wanted to get out of an option position and they thought they could get away with it. So they manipulated the fix lower and then brought the fix right back up. In other words, they moved physical metal during the fixing price that was nowhere close to where the paper market was trading at that moment in time. But what we've been seeing, for quite some time, John, actually, is this divorce or splitting between the physical market for silver, physical market for gold, and the paper market for silver and the paper market for gold. And as the disparities between these paper and physical markets increase, you're going to see more and more volatile events like this one, where the two markets are trading completely in a historically illogical way to one another.
And piggybacking on that a little bit here, James, first gold, but now in the past week, silver has been rapidly vanishing off of the dealer inventories on the COMEX. The silver is now down, I think, to levels last seen in 2011. So we have basically a 5-year inventory build in silver ounces has been depleted in just a few short months here. What's your take on the state of the physical market? My perspective is we're not currently seeing the type of shortages we saw in Q3 when we had absolutely record investment silver demand, but we're getting a lot of anecdotal evidence that the wholesale market is actually tightening up early this time. I'm hearing a lot from the big mints and wholesale dealers here in the U.S. that 1,000-ounce bars are becoming scarce. What are you hearing, and what's your take on that?
Yeah, I'm basically, hearing the same thing that you are, but I'd like to first look at what happened to gold and then lead into silver from that, because the way I see silver is I see it as a gold substitute. In other words, 78 ounces of silver today does the same thing for you as 1 ounce of gold does. It gives you money outside the banking system. And what happened, because in Asia, the demand for gold is primary or greater than the demand for silver, you are seeing physical metal moving from west to east. This has been going on for quite some time. And the refiners in Switzerland particularly continue to get orders for kilobars from China and other places in Asia. So they have to get the physical metal from somewhere, and the amount of demand that they're getting from Asia is greater than mine supply. So it has to come from existing above ground stocks if the demand is going to be met at current prices. So what the Swiss refiners did is they saw all of the gold in the COMEX and basically took as much out of the COMEX inventories as they could in order to meet the Asian demand. They took the 100-ounce bars, and to the extent that there are kilo bars there, refined them down, turn them into kilobars, and send them over to Asia until basically what you have left in the COMEX is essentially nothing in terms of the registered stocks. They still have some eligible stocks behind it, but as far as we know, those eligible stocks may be strong hands, and anybody who owns eligible stocks may not be thinking about parting with those eligible stocks unless they get a much higher silver price. They might be thinking, well, okay, I'll be enticed to sell my silver stocks or silver, bars at say $25 or $30 an ounce and hold dollars instead. But until then, I'm going to stay with my silver. So you can't look at the eligible. You only have to look at registered, and COMEX has been basically bled dry. Well, because gold is so tight, physical gold is so tight worldwide, if you can't find physical gold, what are you going to do? You're going to go for physical silver. So the physical silver stocks are now also, being drawn down, and are not as deep as they were previously. So as the existing visible silver stocks get drawn down, you're setting up what I think could be a massive short squeeze, where people who've made promises to deliver physical metal at some future date will not be able to get physical metal at anywhere close to existing prices. So I'm looking for the year ahead, John. I'm actually quite bullish on the precious metals. And because historically the gold-silver ratio is high, it was recently at 80. It's come down a little bit. It's in the high 70s. And in April of 2011, the ratio was 30. I would expect over the course of the next couple of years, you're going to see that ratio move from the high 70s down to into the 30s, if not lower, which basically means that silver is ready to start outperforming gold, which is something we haven't seen since the last bull market ended in 2011.
Exactly. For listeners who might be new to the markets or might not be totally following what we're explaining, if you could walk the listeners through the process of what we've been describing with the inventory and availability issue on the COMEX, of how that can result in a massive short squeeze. The basic economic principles of how that's going to happen. I mean, it seems pretty straightforward to yourself or myself, but maybe for new listeners or new investors in the market, explain, I guess, the economics of what happens when there's no availability.
Yeah, there are a lot of, first of all, there's a difference between paper gold and physical gold, and paper silver and physical silver. A lot of people have sold paper silver thinking that they're going to be able to buy it back. A lot of it is speculators. And a lot of people are speculating in terms of some of their contracts. Not only are they risking a price, but they're also risking a forced delivery against those particular contracts. So there are certain paper contracts that are out there that settle not in dollars, but settle in ounces. So if you have one of those contracts and the price goes up, you can lose money that way, but you also have to deliver ounces in order to fulfill your obligation. If you can't fulfill your obligation, you then default, and that has all kinds of legal implications. So when I talk about a short squeeze, I'm talking about the people who've sold paper contracts denominated in ounces, who could be put into a situation where the buyer of that contract says, well, yeah, I don't want dollars to settle this contract. I want ounces, and you give me the ounces that I need in order to fulfill your obligation. And it's like when you're selling a stock, you have the share certificates. You borrow the share certificates, and you're selling them, and you have to get those share certificates back. It's basically the same principle. There's some nuances that are different with silver than certificates, or gold than certificates, share certificates, but the same principle is the same. If you sell something where you're denominating it in ounces and you are committed to delivering ounces, if the buyer wants ounces rather than dollars, you have to deliver those ounces or default. And that is actually a very, very bullish situation when that happens, given the tightness that we're seeing in both gold and in silver.
I mean, the type of numbers we're talking about, particularly in silver, are quite astonishing. The registered dealer inventory dropped just about 8 million ounces in a single day over the past week. Recently, they seem to all have been coming out of CNT, Coins and Things inventory. CNT had about 4 million ounces withdrawn in a single day. And to put that number in perspective, they now have around 400,000 ounces left in inventory. Brinks is one of the only COMEX dealers that has any significant inventory left, but they only have about 10 million ounces. So there's definitely the potential for what you're talking about, James, of a short squeeze, particularly with the level the sentiment has been over the past, I'd say, 18 to 24 months. We've seen sentiment probably at the level, or perhaps worse than the late 90s, in my opinion.
Yeah, and here's the key, John. When you're a buyer of a paper contract and you ask that short to give you physical ounces rather than dollars, the short could declare a force majeure and says that, well, there is no physical available, and the government or the exchange might support the short rather than the long. And you end up with paper rather than physical. And it could be even worse. They might say that because you're speculating, that they don't give you the dollars at the current price. They give you the dollars at the price you price the contracts. So in other words, they take away your profit just to settle the trade under a force majeure condition. At the bottom line, what I'm saying, just to keep it simple for everybody, is don't fool around in the paper market. Own physical gold or physical silver. There are too many risks of owning any kind of paper. When you own paper, gold or paper silver, you don't own gold, you don't own silver, you own somebody's counterparty risk. And the counterparty risk in this environment is way too great. So stick with physical gold and physical silver. That's where the safe havens are.
I couldn't agree more. I want to ask you a question similar to one that I asked Eric Sprott last week, just for the readers and the listeners, so they can get a little better picture into your mind and how you analyze the markets. Every analyst out there has been, well, not every analyst, but most of them have been trying to call a bottom in gold or silver for the last couple of years, and we hadn't seen it. Perhaps we have now, but I kind of wanted to get your thought process in. What do you look for when determining whether a market like gold and silver or that sector is in the process or has made a major secular bottom? What are the types of things you look for and take into consideration, basically? So rather than just telling us, oh yeah, I think it's bottomed, give us a little bit into your thought process of what you look for.
Okay, well, first, for the sake of disclosure, I've been one of those analysts that have been looking for a bottom the last year or two. And it just hasn't happened, which just goes to show that, timing is everything and timing cannot be predicted. But there are trends and things out there that I do look for. The simplest thing is the price of gold or the price of silver above or below its 200-day moving average? If it's above its 200-day moving average and that 200-day moving average is rising, you know you're in a bull market. And reverse, if the 200-day average is falling and the price is below that 200-day average, you know you're in a bear market. But there are more subtle things I look for. I look at the flow of physical metal, because at the end of the day, physical metal ultimately drives the price rather than paper. Although paper can influence it, at the end of the day, like we were discussing before, you're obligated to deliver physical, and you could end up defaulting if you don't have that metal behind your obligation. One of the things to me that has kept me so extremely bullish on gold, is looking at it from and silver too, looking at it from a technical point of view, is the backwardation. In other words, the spot price continuing to trade above the forward price or the future price. The premiums that you see on different physical products, be it coins or small bars or even larger bars, that's an indication of tightness. And when you see tightness in the market, or the lack of liquidity, or the lack of readily available supply, that's an indication that the market is ready to start moving up. So we've seen all of these things over the past couple of years. The problem is that the people that don't want gold to rise, the central planners that want to maintain this fiat currency system that's unsustainable, they've been pulling out all of the stops in order to try to keep the precious metals lower. And for example, you're seeing gold for the past couple of years flowing out of the Federal Reserve, coming over here to Europe and being put into the market by various central banks to try to supply physical metal to the market over and above what's being supplied by new mine production. All of these things together suggest that the market is operating in an abnormal way. And this has happened before in history. It happened in the 1960s when the central bank cartel called the London Gold Pool was controlling the gold price by keeping it at $35 an ounce, when everybody knew that gold was worth more than $35 an ounce. So they kept on buying physical until eventually in March of 1967, the central banks had enough. They threw in the towel, and rather than empty their vaults completely, said, we're going to let the gold price rise. And that led in the big bull market that lasted for another 12, 13 years. We're in a similar situation today. The physical market is just so tight. At some point here, I think the central banks are going to have to throw in the towel and say we're not going to take any more gold out of the Federal Reserve or from our existing stocks and put it in the market because gold is too valuable. The existing monetary system is falling apart, and we're going to need that gold to go back to a new sound monetary system after this one collapses because of the huge level of debts that we have in the system. So those are the things I'm looking at the market, but then as I'm applying in terms of my discussion, I'm also looking at bank reports and bank charts of bank stocks. Stocks like Deutsche Bank, the price of that share is at the same price it was at the lows in 2008. And the financial crisis hasn't even started yet. So, what's going to happen to that stock? What's going to happen to that bank? If you look at the Italian banks, I just read recently in the Financial Times that 17% of the loans in Italian banks in the aggregate are non-performing, meaning that they're not likely, they're a bad loan. It's not likely to be repaid. Interest is not being paid or whatever. I mean, the banks in Italy are basically insolvent because they don't have as much capital as they have bad loans. So all of these things together to me suggest that you want to be minimizing your risk wherever you possibly can. And the way to minimize your risk is to own tangibles of all sorts or near tangibles, which I would define as a share of a company that deals in tangibles, like shares of mining companies or shares of oil companies or valuable real estate like agribusiness and things of that nature. I think what I'm basically saying, John, is that if not in 2016, then probably by 2017, we're going to see another 2008 type crisis.
What's your take, James, on if we do see another 2008 type crisis on the mining sector? 2008, they were hammered, but then they recovered very strongly over the next couple of years. And as we fast forward to today, the sector's in really dire straits. The sentiment is atrocious. The valuations are terrible.
Yeah.
What's your take? Do you think this is an excellent opportunity, or on miners, are you be more thinking to wait until a financial crisis?
Yeah. First of all, let me say that gold and silver, physical gold and physical silver, are fundamentally different from companies that mine gold and companies that mine silver. Physical gold and silver are money. Mining companies are investments. So, portfolio has cash and a portfolio has stocks. Gold and silver go into the cash component of your portfolio, and you compare what they're doing compared to the national currencies. Mining companies go into the investment part of your portfolio, and that means you have to look at all of the things you do when you make any investment. You have to look at management, balance sheets, country risk, and all of those different things. So recognizing that the two are fundamentally different, if you're inclined to make an investment, the mining shares to me look cheap here and are likely to go higher as the prices of the precious metals themselves go higher over the course of the next year or two. But there are a lot of risks that you find in your investments in mining companies that you don't have with your purchases of physical gold or physical silver.
We always appreciate having you on the show, and if you could let listeners know where they can find your book. I assume it's available on Amazon?
Yeah, it is available on Amazon. It's called The Money Bubble, What to Do Before It Pops. It's written by myself with John Rubino, my good friend. There's a lot of useful information in there. It goes into detail on some of the things I've just covered, just touched the surface on in our conversation, but I think people will find it to be very useful.
All right, so we'll wrap up this week's show there. James, always a pleasure to have you on the show.
Thanks, John. Good talking to you.
All right, for the Doc and James TURK, thanks for tuning into this week's SD Weekly Metals and Markets.